I'm Michelle Nofel, Head of Distribution. I want to welcome you to our City Different Investments quarterly webinar. We are 1 week from Election Day, and I'm sure that's top of everyone's mind. Our investment team is here on the call today, and we have fixed income co-portfolio managers Chris Ryan and Shweta Singh, portfolio managers Rob McDonald and Connor Brown from our domestic equity team, and our global portfolio manager, Vin Walden, along with senior analyst, Jong Lim. As a reminder, if you do have any questions, feel free to type them in the Q&A box, and we'll address them during the Q&A session. Chris Ryan will start us off in discussing the state of the economy. Chris.
Thanks, Michelle. Good afternoon. Well, last quarter's reports of the economy's demise, whether it be a recession or a soft landing, seem to be exaggerated this quarter. We've had some strong employment numbers come out. Hourly earnings are up. Non-farm payrolls were a big surprise, over 100,000 over expectations. And today, JOLTS came out and was a little bit below expectations, but at 7,400,000 jobs, still well over the 20-year average of 5,700,000 jobs. CPI is a little bit higher than expected. Core CPI, again, a little bit higher than expected. There's still a lot of money in the economy. M2, measure of money in the system, is extremely high. It's about a 1.4 standard deviation event, which is high. Velocity is on the rise. Bloomberg Index of financial conditions is currently today at 0.78 versus a long-term average of minus 0.30. And finally, the Atlanta Fed's GDP estimate for the third quarter, 3.4%. We'll find out more about that this week. This week is chock full of numbers, which could make me look like quite the idiot by the end of the week. But everybody's wondering about, the Fed funds rate. What did the Fed make a mistake at cutting rates by 50 basis points? I don't think so. The real Fed funds rate is extremely high based on a 20-year average. And everybody's looking for what R star is. That is the Fed funds rate that is neither supportive or neither is supportive of the economy, nor is it constricting the economy. R star is very similar to pornography. Nobody knows what it is, but when you see it, you recognize it. So, right now, real Fed funds rate is running positive 2.13% versus a 20-year average of minus 0.37%. So for those statistically inclined, that's a 1.7 standard deviation event before the cut and a 1.4 standard deviation event after the cut. Still very high. Little anecdotal story about how strong the economy is. My wife and I visit our daughter in California a number of times, probably 6 times over the last few years, and we drive on I-40. Well, 6 months ago, when we drove over, there was very little truck traffic, and you get a great view of freight trains, which is kind of cool when you look at them because they're really long and they have a lot of engines pushing them around. The freight trains 6 months ago were probably down 30% from what we noticed before. This trip, truck traffic on I-40 extremely high. Freight train traffic extremely high. Double-decker freight trains, extremely long trains, needing 2 engines up front, 3 in the middle, and 2 in the back. So the economy looks strong to us. Also, the infrastructure money is at work. I-40 being an interstate gets a lot of truck traffic. It was in terrible shape. It's been given a facelift over the last 6 months with more, a lot more asphalt piled on the sides, ready to be deployed. Given that view of the economy, I'd like to turn it over to Shweta Singh, my partner, to talk about the volatility that this stronger economy is bringing to the markets.
Yeah, thank you, Chris. And we wrote about it in this week's weekly, Fixed Income Weekly as well. The next 10 days are are full of volatility for both equity and fixed income market, but specifically to fixed income. There are two aspects here. One is the plethora of data releases poised for this week and next week. Chris mentioned starting with the employment numbers, core PCE comes out, Fed's favorite measure of inflation comes out this Thursday. Of course, then there is the election on Tuesday. Irrespective of wherever we may all fall in the political spectrum, one thing's for sure, it is, say, 48%, depending on polling or election prognosis, which we are not in a business of. So it's a really close election. Does that mean, do we get the results on Wednesday, or does this prolong into Friday? And why this is important is because the Fed meets on Wednesday as well. And Chris mentioned 50 basis points rate cut in the previous meeting. And right now the market has us poised for maybe a 25 basis points rate cut too. Not that in any way do political events shape monetary policy, but there is a lot of volatility in the market, both in terms of where these macroeconomic numbers land and also in terms of election. With regards to fixed income market, what this means is liquidity. For right now, in both markets, in the municipal bond market and in the investment grade market, we've seen very big issuance calendars. In the high grade investment grade corporate market, we have over 20 billion that's pricing this week. On the muni side, we have a 10 billion plus calendar. Both Chris and I think that this is sort of the tail end of issuance in both these markets, the corporate and the muni market. So whatever the results are, the next couple of months, the remainder of this year, really, we are on the fixed income side braced for volatility. How that translates into our portfolio is on the duration side for both our taxable and municipal strategies, we are duration neutral. We are fully invested in all of our municipal and taxable strategies, and we are staying true to our process and philosophy. That's it.
Thank you, Shweta and Chris. Now we'll move over to our domestic equity team. Connor, what's going on in the U.S. market?
Great. Thank you, Michelle. Yeah, it is a wild time right now with a lot of uncertainty. Generally, the equity markets don't like uncertainty headed into an election and appreciate getting to the other side. But the markets have been strong. So who knows? Who knows what's going to happen November 4th? We're within margins of error. If we take a step back, I, in one of our quarterly letters, which should be out soon, highlighted a recent strategy piece released by Goldman. Their empirical evidence is not nearly as strong as Chris is counting freight trains on the drive out to California, but, they do okay work over there. As a manager, Rob and I on the domestic side, we manage multi-cap core, which is a small, mid, and large cap up against the S&P 500. And we manage a small and mid cap core strategy. So some of this will sound like talking our book in terms of supporting why it makes sense to have exposure to those strategies. But I wanted to get it in front of everyone. And especially, I'll talk through where they might not be right. But the headline is that Goldman over the next decade predicts 3% annualized returns for large cap U.S. stocks for the S&P 500, which is just barely above their 2.2% inflation prediction. And they think that return has a 72% probability of underperforming fixed income over the next 10 years. Go ahead, talk to Chris and Shweta if you're looking for some fixed income. That sounds terrible, like really bad. And I think they created some hubbub with this report because of how low their projections for returns are. Now, on the equity side, it's city different. Rob and I, then John, the team, Generally, we're not very good at predicting the macro. We like doing work on underlying stocks. So we are not experts on the macro, but their case, just to explain it, really surrounds concentration in the S&P 500. We all know this, Mag 7, AI, et cetera, are driving so much of the returns of the S&P 500 these days. The 36% concentration in the top 10 holdings for the S&P 500 today looks way out of line relative to even 100 years worth of data in the US stock market. So we are highly, highly concentrated. And on the one hand, valuations amongst those holdings don't look too high. The 10 largest stocks have a median forward PE today of 31 times relative to growth prospects and profitability. That's high, but might not be that high. The difference between that and the median in the S&P at 19 times is really extreme. And it's this concentration factor in their numbers that drives the lower return. Like a very reasonable question is why do forward returns depend on concentration? They present good data that says that growing fast is really hard to sustain for just a handful of companies. Sort of the main explainer of why they think periods of high concentration lead to lower forward returns over the history of the S&P 500. I'll give you a little bit of counter evidence. There's some reasonable case that AI is absolutely transformative to the global economy, and that the resources required to develop large language models are so great that the very largest companies in the US and in the world have potentially a sustainable competitive advantage in the development of this really important tool that we may use ubiquitously in everything that we do. On the other side, at the time, it's hard to imagine anyone other than OpenAI or NVIDIA or Google or whoever it is leading the next charge of development in AI. But I will point out, number one, where did OpenAI come from? For OpenAI to have developed up against a Google or a Microsoft or a Facebook or Meta or the others and develop the tools that they have is pretty surprising, given that thesis that you need these huge resources in order to develop successfully. And second of all, poor Intel has had such a rough go recently. We don't own Intel, but if you think of them as the absolute leader in a small architecture manufacturing of computer chips, so important to everything that we do, not the graphics processors that drive NVIDIA and AI development. But I think 10 or 15 years ago, it would have been really hard to imagine Intel not in a leadership position manufacturing these chips. So all is to say, we continue to believe in a bottom-up fundamental approach, and on the domestic side, we really are weighted towards mid and small cap, both in our multi-cap strategy and in our small and mid-cap strategy relative to the S&P 500. My advice would be to make sure that you've got some exposure to those very largest names within client portfolios, but maybe not too much. And you give active managers in small and mid-cap or multi-cap up against the S&P some room to outperform if the paradigm changes over the next decade. Thanks, Michelle.
Thank you, Connor. All right, shifting over to our global team. Ben, what are you finding interesting out there?
The macro environment has been particularly dynamic, and we have our eye on those developments, whether it's the Bank of Japan and the exciting carry trade stuff we talked about at the beginning of August in this past quarter. Inflation coming down, as Chris talked about, overall very benign environment for equities this year. But we're the bottom up guys. We're focused on microeconomic analysis of individual investments, looking for long-term opportunities. So those bigger picture items and a lot of the media headlines about politics, et cetera, that's sort of the background music or the context for us. We find on a bottom-up basis, plenty to do, plenty to be enthused about. So with respect to AI, of course, that's a big deal. There's hype there, but there's also a lot of reality, a lot of spending and investment, and we're thinking about companies that will benefit and participate in that wave, and as things may play out there. An overlapping theme is this consumer-enabled technology that we've talked about a fair bit and written about on our blog, and we have an investment in this area down in Latin America, a company called Mercado Libre that we've written a fair bit about. In the US, we have some consumer and entertainment-related businesses we think continue to benefit from a nice tailwind of technology adoption. And a third area I'll call out that continues to be real important for us is the global energy transition. And this is a structural reshaping of how we consume and produce energy on a worldwide basis. So it's massive investments going on, and we think good risk reward propositions for our investors. We keep digging around there on a continuous basis. But overall, I would say this, the market's been very, very strong. Equity market's very strong this year, on the heels of a good 20-year run, you could say, that we've all enjoyed. But the S&P today is up as of this week, up around 22% year to date. So even by the standards of recent years, it's quite a bit above average. So enjoy that, reality, enjoy the results that we've experienced this year, but nevertheless, stay focused on the long term and don't let the politics and the macroeconomic developments, knock you off your game, knock you off course with respect to a long-term objective. That's kind of how we're approaching things. And like always, lots to do and a lot to be enthused about in our equity portfolios over the long term.
Great. John, you want to share where you're finding some interesting opportunity?
Yeah, sure. So as always, we are looking for investment ideas to bolster our portfolio. Like Vin and the team mentioned, we are very micro focused. And again, we're super excited about this energy theme that, again, Vin just spoke about, that we've spoken a lot about. So as you can see on this slide, we really like nuclear energy and uranium as a long-term investment. And recently we refreshed our thinking on this theme as well. And in summary, just to summarize what we've written about in one of our blog posts recently, fundamentally, we think demand for nuclear energy is just getting stronger. It's just getting started as both private and public sectors wake up to the fact that it's clean, it's green, it's stable, it's safer than everybody's presuming. And we can see real evidence already as recent announcements from Microsoft and Amazon to use more nuclear energy. That has really kind of give the sector a huge bump along the way. And supply of uranium continues to be constrained by closure of mines due to low prices over the past decade, and new mines take 10, 15 years to be operational. So in summary, we still like the supply demand outlook for uranium, and we are positive about it no matter who becomes president next week. And you can read more about it in our recent blog post. So yeah.
Thank you, John. So at this time, we'd like to give anyone the opportunity to ask questions. Again, just type it into the Q&A box. Let's see what questions we have here. Okay, so for the fixed income team, are bonds still attractive? Do they still make sense in a rate cutting cycle?
Sure, I can take a stab at that question. Recently, our track record for most of our fixed income strategies reached that 3-year mark. And the reason I say that is for the last 3 years, Chris and I have been on these calls talking about how unattractive spreads have been. And spreads truly, both on the muni market and the corporate market, have been at all-time tights. But the fixed income markets look attractive outside of where credit spreads and credit stories are. Credit, both for municipal and corporates, are really strong and resilient. We been seeing more upgrades than downgrades, and spreads are tight, sure. However, the story here, and the really powerful story for fixed income markets, has been rates. For all of last year, we saw the Fed take the elevator up, right, in terms of where rates were and how quickly they brought them up. We are in a rate cutting cycle, but I like this phrase I heard somewhere, which is how the Fed took the elevator up, but is taking the escalator or the stairs down. We started with a big 50 basis points of rate cut. However, this coming Wednesday, not this coming Wednesday, but next week after the election, maybe it's a 25 basis points or maybe nothing at all, right? The economy, as Chris mentioned, Atlanta Fed, really strong, a 3% handle, no matter how you look at it. The other piece in the economy is the labor market. Very good, strong, resilient labor market. The US consumer is strong. So all of this supports maybe a more patient rate cutting cycle. In the corporate market, we are seeing 4% handles, similarly attractive rates on the muni side as well. Last month has been really interesting in terms of volatility. We've seen Treasury market move somewhere in terms of 60 basis points in rate rally. And that's the volatility that all of us, the equity team members and the fixed income team, has been talking about. In light of all that, long-winded answer to say, hey, rates still look attractive for both the municipal markets and the Treasury and the risk asset markets. And we like bonds right now.
And the question is, where do you like bonds? We've just been through a period where you've had 2 years of an inversion where short rates were higher than long rates. That made money market funds look very attractive versus all other bond funds. That's reversing right now. In August, the inversion reverted to a positive slope. The spread that most people talk about is the spread between 2-year Treasury and 10-year Treasury. Today, that's at 15 basis points. Long-term average is 100 basis points. So although bonds across the curve are now giving you real rates of income, adjusted, income versus inflation, the short end of the curve is giving you the best relative value. So that's where we're focusing our SMAs, overweighting 1 to 5 years and underweighting 6 to 10 years in our limited term space. I think what you're going to see with the rate cutting environment is that the curve is going to steepen back to historical averages. And I hate to say it, those people who kind of stay too long at the money market party could be disappointed as rates continue to drop. Over the last month or so, money market fund rates have dropped about 50 basis points. So that move is on. Halloween's coming up, and the goblins of the cash trap are making themselves known to everyone. So be careful out there.
Thanks, Chris. How are the domestic portfolios positioned heading into the presidential election?
The domestic team doesn't know who's going to win the election. I think it's going to come down to a few voters in a few key states. The betting markets are starting to move towards Trump. Maybe even the stock market might be leaning a little bit towards Trump, but I think at the end of the day, who knows? I think everyone's stressed out. I think everyone will be scared if their candidate doesn't win. And so this thing about this environment, we don't know who's going to win. And when that candidate wins, we don't even know what they'll actually do. So it makes it really hard, to take big bets. There is a chance of some turmoil, contested election. That would, in almost all cases, be stock market negative in the near term. For our portfolio, we're trying to be balanced. We own some stocks that will do well if Trump wins, some that will do well if Harris wins. And then if there is some volatility, we want to try to make some good decisions and take advantage of opportunities.
Great. Here's a question for Vin. Vin, could you comment on major changes in your global strategies this year?
Sure. Overall, there have not been major changes. So if you've been following our letters or our blog posts, those are of the past year or more, those are still relevant. Last year around this time, we talked about our LNG related investment, a company called Golar LNG, that's been an important contributor and still an important investment for us. The beginning of this year, we wrote about our investment in American Coastal Insurance. The same holds there. That's still relevant. So we find these themes I mentioned earlier, consumer-enabled technology, technology-enabled consumer companies, as well as energy transition, to be very, very vibrant, broad categories with a lot to do, and those are important actual holdings and probably important areas for us to continue digging around. You can read more about this on our website, including our quarterly note for the third quarter, which we just published this week.
Great. So that wraps up the Q&A session. Before we go, I would encourage you all to visit this blog section on our website. As Zhang and Vin mentioned, we do have a new blog post. It's called A Looming Uranium Shortage. Chris and Shweta also write a fixed income weekend review, which is published every Monday, and that can be subscribed to. So thank you all for joining us today, and we look forward to speaking with you next quarter. Thanks.